And from another different way, we can understand the concept of the present value as follow. The amount that we are going to receive in the future after 10 years, how much is it? It is 259. These 259 that we are going to receive in the future worth today $100. And from another different meaning, if we invest $100 today in the bank, we are going to receive in the future 259. The process of calculating the 259 in the future, how much does it worth today? It is called discounting. And this discounting process, we are using in it a discount rate. And this discount rate is like interest rate. Now, after explaining the concept of simple interest rate calculations and compounding interest calculations, these interest rates and these discount rates are helpful in many different aspects on the business. In the accounting, if you are applying IFRS, definitely you are using interest rate or discount rates in your accounting. If you are applying IFRS 16, you are using discount rate and the present value to calculate the present value of the minimum lease payments or the present value of the lease obligations. If you are using IFRS 15 revenue from the contract, you are using a discount rate and the present value if the revenue, if the transaction with your customer includes significant financing component. So when you are going to calculate the revenue, you should calculate it using the discount rate and the present value as well. And from another different way, another different perspective, if you are using IFRS 9 and you have financial investments under amortized cost, you are using also discount rate and the present value to discount all of the future cash flow. All of these accounting standards, you are using discount rate to calculate the present value for the future cash flow. And in your personal life as well, if you are going to purchase a car, for example, and you agreed with the company to sell you the car on installments, so the installments will include interest component. This interest component is based on interest rate, and specifically it will be calculated on a compounded interest rate. And if you are also working in the finance, the interest rate and the discount rate you are using in order to calculate something, for example, discounted cash flow. All of these examples, you are using interest rate or discount rates in many different aspects in the business. I hope this explanation for the simple interest calculations and the compounding interest calculations help you understand the basics. Definitely, there are more details, especially that I'm assuming that it's $1 or $100 spent or invested today. But what if $100 will be added every month or every year? How can we calculate the interest? How can we calculate the present value? And how can we calculate the future value? This will be called annuity, and this can be explained in another different video, inshallah. Thank you.